All right, let's see this strategy in action. 3 real examples, 3 different outcomes. This is where it gets fun. First up, April 2nd. We get a gap down at the open, meaning overnight session traders are hoping for market to go down. But something different happened at the New York Open. Check the first 2 candles, green, bullish, and strong buying. These candles are an indication that the market is now reacting strongly against the gap from the overnight session strength from the gate, and going by the quality of the first 2 green candles. Traders strongly disagree with the gap down. They are saying, no bueno. That is our signal for a potential entry. Then pay attention to the third candle behavior. It breaks and closes above the high of the second candle. That's our entry. 2 micro MES contracts, 2-to-1 risk. Profit target 80 points. We enter long, and what happens next? Boom. The market rallies hard. A clean 80-point rally straight to target. That's an $800 win per 2 MES contracts. This is an example of a gap and reversal reaction trade. Next, let's look at a continuation reaction trade. Now let's look at April 21st. Again, a gap down at the open, meaning overnight session traders are hoping for market to go down. This time, though, it's different from the previous example. This time, the market reaction at New York Open agrees with the extended hours sell-off. The first 2 candles are strongly bearish and red. The bears are still hungry. That's a signal for continuation and a potential trade opportunity. And the market continues down. And the third candle? It breaks the low of the second. We go short. And the market slides another 80 points. That's another clean win, just following the plan. 2 micro MES contracts, 2-to-1 risk, profit target 80 points. This is an example of a gap and continuation reaction trade. Coming up next is the final example in this strategy. This one is choppy, indecisive, and one that we should try to avoid. Avoiding setups like the next one will be great to improve this strategy overall win rate and avoid drawdowns. Now let's watch what happened on April 15th. We get a gap up at open, but look what happens. First candle, bullish with wicks. Second candle, also bullish with wicks. And third candle is just as messy. Wicks here are indicating competing opposing forces. Even though the third candle broke and closed above the high of the second candle, the elements leading to this setup is not so strong. Check it out. There is a relatively smaller gap at the open, and the first 3 candles, though bullish, have large wicks. This is what we call a no-go. The market may start to range at this point, if the strategy was used. This will be one of those days that a loss may be incurred. It's best that we do nothing. No trade, no drama, no FOMO. If the market confirms, we go. If it ranges, we skip. If it fakes, we wait. Note, this isn't about being right every time. It's about sticking to a process and avoiding the overtrading trap. Sometimes the best trade is no trade.